Welcome to Telegraph Studios. I'm Louise People, and today we're going to be talking about defined benefit pension schemes and the ever-growing deficit. I'd like to introduce Tom Ground from Legal & General. Hi, Tom.
Hi.
So, Tom, why are defined benefit pension schemes such a problem and such a headache for companies?
It's all about the deficit. So if you think over the last 30 years, the deficit has on average increased every year. And last year, the deficit increased by £100 billion.
Right.
And £100 billion is a lot of money. It is more than the UK spent on education. So it's a huge amount of money, and that huge amount of money corporates will have to fund into the future. And it's not that this is delivering them great value. This is mostly for employees that have long since left the company and will add no economic value into the future. So it's a debt that the companies will have to refund.
It sounds like a widespread problem. What is the real source of the problem?
So there's three reasons why there's a problem. The first is that people are living longer than when the schemes were first intended. The second is around investments and the low yield environment. And the third is inflation. So if we roll back up to the first one, which is people are living longer, people, when these schemes were first designed, were on average living to 74, 75 years old. Now, last year, the ONS were predicting that the 65-year-old, when he retires, will live to 84 years.
Right.
And so they're living nearly twice as long as when these schemes were first set up. And that means that effectively they need to pay out twice as much money than the first point they were in first created. The second thing is investment yields. Investment yields are at a record low. And that creates a problem, which is that they've got this deficit and they are trying to take more risk to recover the deficit. And with risk, sometimes risk doesn't pay off and their deficit is increasing. And the third is inflation, which gives uncertainty as to the amount of money that eventually will be paid.
So if these are the problems, what kind of solutions are we looking for?
The insurance is the solution is all around insurance.
Okay.
And so the first solution is you can insure the risk of people living longer. And so if you think the average male retiring, we think he's going to live to 84. But say just for an instant that person lives to 100. Mm-hmm. That means that effectively the scheme has to come up with around 60% more money than they currently are holding for him. And so for one individual, that's not a problem, but imagine that happens for all of the members of the scheme. To come up with 60% more funding is going to be a very big problem for them. And so there's now an ability to be able to insure that longevity risk at scale. The second is a buy-in or a buyout, which ensures the longevity risk, but also ensures the investment and the inflation risk, and gives the security to members that they will always be paid out into the future.
Okay, so with that in mind, let's do a thought experiment. I'm a pension scheme sponsor and I need your help. What kind of help can you provide?
So the very first stages would be to come and talk to us, and we'll help you identify which of the various different insurance options are most suitable. And we can help you do some quick analysis as to where the most appropriate solution is. The second phase would be really to plan how you're going to go to market and choose an advisor that's most appropriate to the solution that you choose. And the third thing is not to underestimate the value of the advisor that you choose, in that they'll be very experienced in this market and can help you make sure that you're comparing similar bids with similar bids, and helps you get around the fact that you are compounded to take advice at every stage of this process.
So can you give me an example of who you're working with?
So we work with pension schemes both big and small. Mm-hmm. Over the course of the last year, we've concluded the largest buy-in with ICI in the pension scheme of AXA Nobel, with TRW, which was the largest buyout. We've also done a very large longevity arrangement with BAE Systems. And then on top of that, we've done over 30 transactions with smaller pension schemes.
Fantastic. So we all know that the environment and the market is ever changing and there's movement all the time. How do we adjust to these changes?
It's all around timing.
Okay.
So this is a market-based product. The scheme will have an investment strategy. The investment strategy will do one thing. We have an investment strategy, and our investment strategy will move differently. Ours is more sophisticated, more international, and so they will move asynchronously. If you choose exactly the right point to do this transaction, what we found is if you choose the right timing, you can sometimes save up to 10% of the cost just from executing on the right time. So the key for that is to be prepared, get your data in place where you can transact quickly, get the contract in a point where you can execute very quickly, and make use of the exact right point where you can transact these transactions.
Planning and execution. Thank you for your time today, Tom Ground.
Thank you.
Thank you.